More insight, more intelligence. Welcome to Monocyte.
Welcome back to the Monocyte podcast, where we decode global trade, business strategy, and what's really shaping the future of our economy. Today's episode: can global trade survive Trump's 2.0 tariff war? Let's dive in. First things first, let's take a review of the streamline. In early 2025, President Trump reignited trade tensions by imposing nearly 40% tariffs on Chinese imports, aiming to curb the trade deficit and address concerns over fentanyl trafficking. China responded with retaliatory tariffs of up to 125% on U.S. goods, including agricultural products and crude oil. These actions led to significant market volatility, with investors seeking safer assets amid fears of inflation and recession. The U.S. administration also announced plans to stockpile critical minerals to reduce dependence on Chinese imports. So, what did China do when Trump hit the trade button again in 2025? Well, they didn't just sit back. In true tit-for-tat style, China hit back hard. On Friday, China's Customs Tariff Commission said it's raising tariffs on U.S. goods from 84% to 125%, starting April 12, 2025. Why? Because just a day before, the U.S. had hiked tariffs on Chinese goods again, pushing total duties up to 145% when you include earlier fentanyl-related ones. China called it outright bullying, saying these U.S. tariffs break global trade rules and make no economic sense. And here's the kicker. China said U.S. goods are now basically priced out of their market, and they won't even respond to any more U.S. tariff hikes after this. China's tougher now, more assertive, more strategic. On the surface, they want to protect exports and their industrial base. But is that all? Some say this trade war could actually push China to innovate more at home. Their dual circulation strategy, focusing on local markets and tech development, might just get a boost. Could this be the wake-up call they've been waiting for? Or is there a deeper game here? Could China use this moment to quietly expand its influence, especially in emerging markets like Africa, Latin America, and Middle East? Another question is, can China withstand the shock? Some people think that the last time, China took a hit but bounced back. Factories adjusted, the yuan shifted, export routes changed. But now, things are shakier. Youth unemployment is up. The property sector is in trouble. And shipping? Oof! Some agents won't even touch China to U.S. routes anymore. Too risky. Platforms like Alibaba, Shein, Temu, even Amazon sellers are already adapting. Some are rerouting products through Southeast Asia to get temporary tariff breaks. Clever, but costly. And let's not forget American traders. Tariffs raise prices, slow down customs, and drive up costs. Everyone's feeling the heat. No one is winning in this endless tariff war. So, if you're listening in the U.S., you might be wondering, how do we deal with rising prices and economic uncertainty? Here's the thing. Strategically, don't panic. You've got to defy the fear. Tactically, be flexible. Look at your spending, invest wisely, diversify your sources of income. Stay informed, not just reactive. If Trump can't show that tariffs are bringing real, tangible benefits, especially in job creation or price relief, then the political pressure mounts. Even Trump, who's more direct and less conventional than most U.S. presidents, will need results. And if he doesn't get them, he may shift tactics just to maintain political traction or satisfy other personal objectives. So here's a big question we don't talk about enough. Is the tariff war really bringing manufacturing back to the U.S., or is it more of a market play? Some analysts think this whole narrative of bringing the supply chain home is smoke and mirrors, a way to manipulate the stock market, drive speculation, and create winners and losers. There's a fine line between industrial strategy and political theater. Sure, some factories may return, but most companies still look at costs. Unless labor, logistics, and regulations align in the U.S., reshoring won't be as massive as it sounds. Now let's talk about something that underpins all of this: U.S. debt. The U.S. government may brush off concerns about its growing debt and the slow pace of interest rate reductions from the Fed. But here's the catch. The world still sees U.S. credit as the glue holding the global economy together. If Trump tries to cut the trade deficit by simply hiking tariffs and dragging back manufacturing, it could backfire. Without deeper reforms, improving the talent pipeline, creating better employment conditions, offering tax incentives for manufacturers, it's just surface-level damage control. Global confidence in U.S. credit matters more than any single trade deficit stat. Undermining that trust could have ripple effects way beyond America's borders. And here's a wild card: artificial intelligence and Industry 4.0. China has been building up its manufacturing base aggressively. AI-driven automation, robotics, smart logistics. They're not just catching up, they're setting benchmarks. If the U.S. hesitates or overcorrects, trying to leapfrog ahead through short-term policy shocks, it may miss the bigger picture. This isn't just about trade, it's about global leadership. And whoever wins in AI and manufacturing dominance over the next 10 to 20 years will shape the new world order. The real question: can the U.S. make strategic moves without relying too much on panic-driven politics? It all comes down to leadership and whether U.S. policies can evolve fast enough to stay relevant in a high-tech global race. Global trade isn't dead, but it is changing. Tariffs may rise, rules may shift, but trade will adapt because people and businesses still need each other. So, the real question isn't, can trade survive? It's, who will shape the next phase of global trade? Thanks for tuning in to MoneySight. If you found this episode helpful, don't forget to subscribe, share, and let us know your thoughts. Until next time, stay insightful.